The purpose of gold in an individual's portfolio is not wealth creation, it's wealth preservation. It preserves your purchasing power. It'll allow you to have some savings to draw on when you need it.
Hello again, everyone, and welcome to another edition of Silver Bullion Television, SBTV. I'm your host, Patrick Vieira, part of the outreach team of Silver Bullion here in Singapore, where we want to help you truly secure your wealth. Joseph Brown, yes, the Joseph Brown that started Heresy Financial, joins us today. Joseph has been teaching many of us how money works so that we can control our financial security. Joseph provides anyone who wants the needed education to help prepare for the coming economic storms. And we are indeed going to talk about these coming economic storms already both happening today and looming on the horizon. It's time to saddle up and silver up with first time guest Joseph Brown. Joseph, welcome to SBTV. How are you doing?
Very good. Thank you for having me.
Thanks for coming on. You are one of the guys that absolutely find the most amazing ways to simplify complex issues and help teach it to the rest of us. So I appreciate that. And it's one of the reasons I wanted so much to have you on. So thank you again for being here. First question. We see the US government talking about the debt ceiling once again, and this debt ceiling issue may or may not be resolved at the time we post this interview. But in your words, what is the debt ceiling and why do we see Congress needing to raise the debt ceiling seemingly every time it comes due?
Yeah, okay, so some background on this. Um, the United States, the way it used to get debt was anytime it was going to borrow for anything, Congress would have to do a vote and they'd have to get authorization for, hey, we've got to borrow this amount to spend it on this. And then next time they're like, hey, we need to borrow. And so in order to get around that, having to, go through all that whole entire process every time they needed to borrow any money for anything, they decided, hey, we're just going to set a debt ceiling. And then we can borrow as much as we want for any purpose that we want until we hit that max. And then we'll have to pay it off. And then, we can get more debt from there. The reality is once they did that, it just made it easier. And so every time they hit that debt ceiling, instead of just paying the debt down and then getting new debt, they just voted to increase the debt ceiling every time since then. Um, and so this is like the simplest way to put it is just like a personal credit card. Let's say you've got a $50,000 credit limit on your credit card, so you can spend $1,000 and then tomorrow spend another $1,000. The next day spend another $1,000, and if you do that for 50 days straight, well, you're going to hit that $50,000 credit limit. And then you go to swipe your card, the transaction will get declined. It won't go through. You're maxed out. So the only way then to borrow more would be to pay off some of that debt, and then you free up some of that credit line. You could borrow again. And so that's the way the debt ceiling is supposed to work. But obviously, we know they just vote to increase it. And most people, if they were in charge of setting their own credit limit, if they got up to that $50,000 limit, and they may just decide, we're going to raise our limit to 60 grand now instead of 50 grand. And since they're the ones in control of that, usually they do that. Now we're at this place again that we've hit many times where we're at that limit. And so both sides are arguing. They're saying, hey, we'll vote to raise the limit as long as you give in on some of our demands. And so the Republicans are trying to get certain spending cuts. They're very minor and they are meaningless in the scheme of things. They won't actually help if the goal is to reduce spending. But the Democrats don't want to give in to that. They want to save face. The Democrats want to increase spending. They want to increase taxes. So both sides are trying to get what they want and kind of getting closer to that debt default, which I'll explain in a moment. And so what we're at that debt ceiling, and we have until probably June 1st until the money runs out, because the government has a checking account basically that they're drawing down on. And June 1st, that checking account will be basically empty. And so they'll need to borrow more in order to keep spending everything that, paying all their bills that they have to pay. And so they're both sides are basically saying, hey, you give in or else we're going to default. And they're both pointing fingers at each other. Now, when they say default, what they're saying is default on the debt, meaning we have debt payments due. So we've got a payment to the credit card. Basically, we've got T-bills and treasuries and bonds that are maturing, and we're not going to be able to pay the interest or the principal back on that debt. And if that were to happen, if that debt gets defaulted on, like you miss a payment to your credit card, then all chaos breaks loose. The entire global financial system melts down overnight because the U.S. government's debt, those are U.S. treasuries, that is the bedrock. That is the currently considered the risk-free reserve of the entire world. So all the sovereign wealth funds, all the central banks around the world, governments, large financial, any financial institution, and then most large corporations, their savings account is all just loans to the U.S. government. It's all just these treasuries. So if the U.S. government defaults on that and doesn't make a payment, it's over. Everybody starts liquidating those because it's now, they're no longer, worth as much as they were, because now you have to, question whether you'll get paid back. So that will not happen. And actually, what most people are missing is that it won't even happen on June 1st. So if the government runs out of money and the debt ceiling is not raised, the debt actually won't get defaulted on. They'll still make the debt payments because they just have to make sure they don't increase their total amount of debt. And so as they pay off old debt, they can take on new debt to pay off the old debt. It's kind of like doing a balance transfer on your credit card. So they can do that, and they will do that. They will not default on the debt. What they will default on, though, is other payments. And so the other things like maybe Social Security payments or Medicare payments or government paychecks, government employee paychecks, those things they won't be able to send out, but they'll have to pay the debt. The Constitution and federal law say you have to pay that debt, and so there's you don't have to pay the other stuff. And so that's what will really happen is that if the debt ceiling is not raised, the government is just instantly forced to bring spending down so that it's the same as what they're bringing in from taxes, which in my opinion would be the best case scenario. But ultimately, they will probably raise the debt ceiling.
This sounds like a husband and a wife who have a joint savings account, and the husband is pointing his finger at the wife. What happened to all the money? And the wife is pointing her finger at her husband. What happened to all the money? And the two are just kind of bickering, going back and forth, and they don't understand that they each contributed to this. So, well,
Hmm.
anyway, that's to me it just seems this way.
Yeah.
Uh, I saw you mention one other thing though that could get them out of this whole debt ceiling fiasco, this idea of the $1 trillion platinum coin. And if this idea should ever come
Mm.
to be, does that mean every US minted platinum coin would reap that $1 trillion benefit, or is it just limited to a specific amount of coins?
That's a great question. The $1 trillion coin idea is a really interesting one because um, the United States government has the authority by the Constitution. So this is kind of base layer law to mint coins, and so traditionally that was gold and silver, but I can't remember the exact year. I think it was in the 90s. They were minting platinum coins by this time. And because the price of platinum, they wanted to create smaller platinum coins, but it wouldn't have been profitable. So they needed a way to be able to sell the platinum coins at a different price than just the metal. So there's a little line written in federal law that says the Treasury has the authority to declare the value or the price of a certain platinum coin as long as it's a proof coin. And proof coin just means it's just that specific coin. So they're not making a declaration on the value of the metal; they're making a declaration on the value of that coin, and they have the authority to do that. So not with gold, not with silver, but with platinum, they have the authority to make a coin and just say that coin is worth this amount of money. Um, and the reason why it's platinum is just because of that, old law that happened when they were trying to make these collector's coins. And so it has nothing to do with the metal. It's just that's what the law is specific to. So the idea is The Treasury will make one coin made out of platinum. They have the authority to then say that that coin has whatever value they want. So they could say $1 trillion, they could say $10 trillion, they could say $1 billion, whatever. And so they say $1 trillion. Now, what they would do with that, because nobody has $1 trillion. They couldn't sell it to anybody, and they wouldn't need to sell it to anybody. They now, by law, have something that is worth $1 trillion because they've declared it to be so. What they would do is they would walk over to the Federal Reserve and they would deposit it, because the Federal Reserve is a bank, and it is a bank for banks, and it is a bank for the federal government. So they would go deposit their coin with the Federal Reserve. Now, if that's all they did, they would have just credited the Federal Reserve with $1 trillion. And that's an uneven transaction. So to make the transaction even, what the Federal Reserve would have to do is print up $1 trillion and deposit those $1 trillion into the government's checking account. Because then it's an even swap. Then there's no financial change that has taken place. I give you something worth $1 trillion, you give me something worth $1 trillion, and it's an even split. Um, and then once the government gets that deposit of $1 trillion, then they can spend it however they want. They can pay the debt, they can pay the interest on the debt, they can make all their payments, and essentially they don't have to worry about borrowing more in order to make their payments. They never have to worry about the debt ceiling again. And essentially what this does is, through these loopholes, it just allows them to take control of the printer. Because the government doesn't actually have control of the printer. For most countries, the printer is the central bank, and that is separate from the central government. They're separate entities by design, so that governments can't just print all the money they want. And so this would be using these legal loopholes in order to kind of through the back door, take control of the printer. And anytime they needed $1 trillion, they could just create another one of these coins, deposit it with the Federal Reserve, and then they have another $1 trillion to spend however they want. They never have to worry about borrowing. They never have to worry about the debt ceiling again. And essentially it flips the system over into printing for expenses instead of borrowing for expenses.
If you're enjoying this interview with Joseph Brown and I, please subscribe to our YouTube channel. And if you would like to learn more about systemic wealth protection and how to truly secure your wealth, please visit us at www.silverbullion.com.sg. Yeah, I had to ask that question for a friend, because this friend was thinking if they should make $1 trillion platinum coin, then all platinum coins might raise in value. So
I wish.
to my friend, no, that's not going to happen. But you touched on something interesting here, because a lot of people wonder, why don't governments just simply print its own money, remove the central bank out of the way? I mean, we essentially contract a private company to create, print, digitize our money, and why not, let's say, then contract out our judicial system? Why not contract out the military to a private company? Why not contract out the presidency? Well, maybe we kind of did already. Why let a private company control all the important money supply and economic well-being of the country and the people, much less the world?
Yeah, that's a great question. There's two ways to answer this, like two directions to go. One direction, which in my opinion would be the best outcome for most people, would be nobody is in control of it. The free market, people should have the freedom of choice to be able to use whatever money serves their needs best. And there should not be any entity with a legal monopoly on money creation. And so the way that so obviously that's probably, that's a pipe dream. And so the system we have now, is an entity separate from the government that's in control of that. So is that better than the government being in control of itself? Well, one common phrase that I always like to refer to is, don't tear down fences if you don't know why they were built in the first place. Because if you do, you don't know what kind of monsters are on the other side might start barreling through and take over your land now. And so we have to kind of go back to see why it was set up that way in the first place. And initially, when the Federal Reserve was set up, the founding fathers in America, they never wanted a central bank. before the formation of the Constitution, the colonies, the states worked through the what was called the Articles of Confederation, and that allowed the government to print its own money. So it printed continentals. So it printed this paper money, and very quickly, because of the needs of the Revolutionary War, they printed it into hyperinflation. So all the founding fathers lived through this, and they realized the dangers of having a printing press. And so the Articles of Confederation allowed the government to do that. When that was done away with and they wrote the Constitution, they changed the powers of the government. Suddenly, the government only had the power to coin money, meaning the money, if the government was going to create it, would have to be either gold or silver, meaning the government's not creating money. They're just saying, hey, the word dollar means, 1/20th of an ounce. And that's the way it was. This central bank, multiple central banks got tried in America until 1913 was the Federal Reserve, was when the Federal Reserve was established. That was the last one that stuck. So when the Federal Reserve was set up, the main concern was if we set up the central bank, the federal government will have access to a money printer for unlimited spending. And so the way that they put a fence up there, they said, okay, well, it's not a government entity, it's a private entity, and they are not legally allowed to make loans to the government. If the Federal Reserve wants to own government debt, they have to buy it off the open market. They're not allowed to print money and directly loan it to the government. And so that was a fence that was put up in place to make sure the government couldn't didn't have control of the printer. Because if you have politicians who are in control and in power, the way that you keep power is by pleasing your constituents, by getting votes. And the easiest way to do that is to spend money on the things they want you to spend, basically enrich your base at the expense of everybody else. And if you have control over a printer, you can do that very easily, but it tips over into hyperinflation very easily and you bankrupt everything. So they put all these fences in place to try and prevent that from happening. Ultimately, today, those fences are very weak. We've found many loopholes around those fences. But they still do exist somewhat, meaning right now, the federal government in their opinion, needs a lot more income because they've got expenses, they've got debt, they don't know how they're going to pay their bills. The Federal Reserve could print that money and could loan it to the government, but they don't. The Federal Reserve is looking at inflation and saying, we're actually taking money out of the system. Even though it's hurting the government, we're taking money out of the system right now. And if the Federal Reserve was a pure government entity, that would not be happening right now. It would be controlled by whichever political party was in control, and there would be much greater chance of financial ruin much faster. And so that's why there's that level of independence. Now, I do need to correct one misconception real quick. It's not a completely private entity. There are district banks, and the governors, the presidents of those district banks are voted into office by actual private banks. So in that way, it is private. And then there are dividends that are passed out to the banks. And so in that way, it's private. But the FOMC, which is the committee that makes monetary policy decisions, those people are appointed by the president of the United States. And so the Federal Reserve is a really weird mix of somewhat being private and somewhat actually being public, because the people in charge of monetary policy are put there by the president. And then after those private dividends are paid out, if they have profits left over, it actually does go back to the government's checking account. And so both the power and the money are kind of split, somewhat private, somewhat public.
All right. Beautiful, beautiful explanation. Thank you for that. Kind of leads me to the question here, though. If you Who's the lesser of two evils? Is it the Fed or is it the politicians right now?
Man, that's a great question. So, one of the unique things about the way that the United States federal government was designed, with the separation of powers and the different branches, it was actually, this is something that people aren't aware of. They look at gridlock, political gridlock, as like a negative. It was designed that way on purpose, because if you have two parties that are, relatively back and forth in terms of who's in power. You have multiple branches of the government that have checks and balances against each other. When one tries to assume too much power, the other one can come in and kind of try and balance that out. That makes it very difficult to get things done, which is actually a good thing, because if the entire country wants one thing to happen, there's a very high chance that that will happen, because all of the branches of government are going to be on board. Both the political parties are going to be on board. We'll be able to move in that direction. One example of this was spending money when COVID started in 2020. People like myself were that said this is a really bad idea. We were the extreme minority. Everybody, Republicans and Democrats alike, wanted to just print money, spend money in 2020. And so it happened. It was easy. There was no friction. Like people like myself, it was like such a small minority that didn't want that to happen. But in times like today, where there's large disagreement, that's actually a good thing, because you don't want it to be easy. If one party has a little bit more power, you don't want them to just be able to slam everything through in their agenda and try and crush the other party. You want there to be gridlock so that the only thing that makes its way through is the stuff that is very, very popular, very, very widespread in terms of what people want. The Federal Reserve is very different than this. They are extremely efficient from the standpoint of there's only a couple of people that vote on policy decisions that impact every single person, arguably in the world, because the dollar is the global reserve currency. And this is a small group of, a dozen people that are unelected. They're appointed. And so they have an extraordinary amount of power, and almost no accountability to the people that are directly influenced by their decisions. So we are at the mercy of hoping that they make the decisions that are in the best interest of everybody. And there's no political accountability. There's very little in terms of fences preventing them from doing things, other than whatever policy decision they feel is correct. So we're kind of just at the mercy of hoping to make the right decisions.
All right. Great explanation again. Joseph, what do you see the Fed doing in the short term? I mean, do you think they're actually going to slow down or stop the rate increases?
Yeah, that's a good question. So the market for the last couple of years has been very wrong about the Federal Reserve. And so basically, in the beginning, they started printing a bunch of money. And once they realized the inflation was higher than they thought it would go, and that it was stickier than they thought it would be, they started telling the market, we're going to taper. We're going to reduce our balance sheet. We're going to raise interest rates. They told the market far in advance, months and months before. And the market did not believe it. The market was not pricing in any of that. And we know this because, like, the big banks, they were loading up on that cheap debt, and now a lot of banks are underwater on that because they weren't anticipating those rate hikes. And so the market didn't believe it. And every step along the way, the market has been pricing in a pivot coming soon, rates dropping again soon, and still to this day, the Federal Reserve, their most recent statements are saying, we may pause raising rates at some point soon, but that doesn't mean we're going to cut rates. And it doesn't mean we won't start raising rates again after we pause. And the market is almost fully pricing in that the Fed will start cutting rates within the next couple of quarters. And so I think the market is probably wrong about this. The only way that that I see the Federal Reserve actually start to cut rates is if we tip over into deflation. And so that would mean the inflation rate, we've been having disinflation for a while now. Disinflation is when the inflation rate goes from 9% to 7% to 6% to 5%. Prices are still rising. They're just rising slower than they used to rise. Deflation would be prices are now actually coming down. So the inflation rate is, let's say, negative 2%. That means prices actually dropped from last year to this year. And so if that happens, then I could see the Federal Reserve cutting rates. But until that happens, I think I think it would be very, very unlikely to see anything other than the Federal Reserve pausing and just holding rates where they're at.
All right. So these are some of the economic storms that we are seeing today. What other economic storms are you seeing today or possibly on the horizon coming in tomorrow?
Yeah, so the biggest long-term threat in terms of like economic storms that I see is the debt buildup, and this is not unique to the United States. This is almost every country on Earth. Basically, we had a period of time where rates were the lowest they've ever been, like in history. And everybody on Earth decided to load up on debt when rates were really cheap. So the government, corporations, households, individuals, everybody just said, I want to borrow as much as I can because borrowing is really cheap right now. So everybody's loaded up to their eyeballs with this debt. But now rates are a lot higher, and they could very easily move even higher if inflation sticks around. And so what that does to your debt is it makes that debt more expensive. Because if your interest rate was 1%, now interest rates are 3%. Just the cost of maintaining your debt triples because it went from 1% to 3%. And so you have to make a decision then. Am I going to continue to just divert more of my income to maintaining my debt? Or am I going to take an even harder hit, divert even more of my income to paying down my debt because the expense of just keeping it would be too much over the long term? Either way, the amount of income goes away because debts you start to have a deleveraging take place when interest rates get this high. And when you have a deleveraging, that removes money from the system. And the problem with something like governments is that as that happens, it means like your revenues go down. So as a business, as a government, if one person has less income, that means they can't spend as much money as they used to, which means that person doesn't have as much income as they used to. And so whether you're a business, your revenues are going to go down. If you're a government, your tax revenues are going to go down. And so for like, especially like the United States government, last year during 2022, the total amount that they spent on interest was $475 billion. During 2023, that number is projected to be just around $660 billion, a 50% increase. During 2024, that number is expected to be about $750 billion. So this is exponentially increasing. And that's the Congressional Budget Office. That's their projections. That's not some fringe, libertarian think tank. This is the Congressional Budget Office. So it's likely understated. There's a good chance that the interest expenses increase even faster than that. And so you get to a point where they're like, okay, well, just to pay the interest, we need to tax more and we need to borrow more. But every time we tax more and borrow more, that makes the borrowing itself even more expensive because it pushes rates even higher. And so you end up in this doom loop. And that's the biggest longer term risk. And by long term, I mean, probably 2 to 3 years that I see here. And the only way out of that is two choices. One is extreme austerity, meaning no more deficits, run budget surpluses, and that means you have to cut an extreme amount of spending. And that means there will be pain for some people. This is not a pain-free option. There's no free lunch. There's always a trade-off. But we either make the painful decisions now and survive, or we'll be forced to take the pain later when we collapse. There's no other option. So extreme austerity is the better option. That's choice number one. Choice number two, which they'll likely do, is just take over the printer. So they'll fold the Federal Reserve, the central bank, into the government, take over the printer. They'll do the $1 trillion coin. They'll do premium bonds. They'll repeal the debt ceiling. They'll do something in order to basically turn it into, hey, we just control the printer now. And so the debt number is meaningless because we just print as much money as we need for our expenses. And then you get massive inflation. And you still get the deleveraging. It just happens from inflation instead of deflation.
Okay, so let's say as all these things are happening, or let's just say they're sort of in the works here, the rest of the world they seem to be dollarizing, where the US needs more and more dollars, but the rest of the world, they don't exactly want to use these US dollars. So, how does this then factor in?
Yeah, okay. So, in terms of the dollar being used as a reserve, like a savings account, that's on the decline. And what's really replacing it, globally speaking, on a net basis is gold. So, central banks are kind of getting rid of dollars as their savings and starting to hoard gold as their savings. And that trend has been going on for some years now, but it's recently been accelerating quite rapidly. Um, uh, but when most people think about de-dollarizing, they think that that means that countries and people are using fewer dollars for transactions. And that's actually not happening. We haven't really seen over the last 20 years, the amount of dollars being used in transactions globally has not dropped, both in dollar terms and in percentage terms. The dollar still makes up an extraordinary percentage of global transactions, especially because the U.S. share of global GDP has shrunk. And so we are not seeing any global de-dollarization on the transaction side. Um, the uh, the reason why, like, I used to talk quite a bit more about global de-dollarization, but I've realized recently the how much global debt there is denominated in dollars. So all the emerging markets, major countries around the world, everybody, they've got a lot of debt. And like nobody I'm not gonna go to Zimbabwe and lend them Zimbabwe dollars because they can print those. So if I lend them Zimbabwe dollars, they'll pay me back some Zimbabwe dollars, but they'll be worth nothing once they pay me back. So I'm not going to do that deal. But I will lend them US dollars because they can't control those. So they've got a lot of US dollar debt. And every country on earth has a ton of US dollar debt. In fact, there's about $65 trillion worth of US dollar debt around the world, and global GDP is only like 100 trillion. So there's a ton of US dollar debt. What that means is, because there's an interest rate on it, it's not free debt. That means that people have to get dollars to pay off the dollars that they owe. And so we are going to see demand for dollars globally for a lot longer than than I used to think. But does that mean that the purchasing power will be there, that the value of those dollars will be there? No, but it does mean that the demand will stay for a lot longer. So eventually, yeah, we could see complete de-dollarization, but that's not something within the next couple of years. That might be something, past, a decade out.
All right, great point. Great point there. Last question here. You mentioned how central banks they're purchasing more gold, holding gold in reserves. For you and I, for the average Joe, for the wealthy, what role does gold play for us?
Yeah, for thousands of years, you look at how much stuff you can buy with 1 ounce of gold. It has been either stable or it has slightly increased over time. And so you could take an ounce of gold and you can go anywhere in the world to any time. You get in a time machine and go anywhere. And if today you can live, let's say, to live for a year, it would take you, let's say 50 ounces of gold. So you got 50 ounces of gold today in whatever country you're at, and that you'll be able to live on that for a year. You go anywhere in the world in any time in history, and you'll be able to live for a year on that gold. And so the purchasing power of gold is very stable. And so the purpose of gold in an individual's portfolio is not wealth creation. It's wealth preservation. It's actually savings. It's just money. So you look at all of these old proverbs about financial wisdom, like in the Bible. There's a lot of stuff from thousands of years ago about hey, these are wise financial decisions to make. They always talk about saving and not getting in debt and just basic financial principles. But every time they talk about money, we have to remember money was always gold. And so it talks about saving, but saving means putting your money in something that will maintain its purchasing power. So if you put your money in most fiat currencies, you wait 10 years, 20 years, it's going to be worth a lot less. That's not saving. But if you put your money in gold, it is saving. Now, again, I need to emphasize this is not an investment. It doesn't make people rich. It just allows you to have money to spend when you need to spend it, regardless of what everything else does, regardless of whether other prices go up or other prices go down. Um, it preserves your purchasing power. And so there is a core portion of everybody's portfolio that should be in gold because you're viewing that as savings. And then you have the rest of your portfolio to invest, and that's to create wealth. And so that percentage is going to be different for everybody. I personally, this is probably a little bit aggressive for most people, but I like about 20% of my portfolio in physical gold. Some of that is held physically. Some of that is in storage, around the world because some countries have done gold confiscation. There's risk with not spreading it around. And so I do think at least a small allocation of gold belongs in everybody's portfolio because it'll allow you to have some savings to draw on when you need it.
All right, Joseph, you are doing nothing short of miraculous work with your company and your YouTube channel. Can you tell the good people out there how to look you up for your services and where to find and follow you on social media?
Yeah, absolutely. The main places where I put up content, number one is going to be YouTube. I make videos all the time on YouTube, and my channel is called Heresy Financial. Heresy is the old religious word that means, basically it means it's an opinion that is at odds with what is generally accepted. And so I'm on YouTube at Heresy Financial, and then I'm also very active on Twitter, same thing at Heresy Financial. And I'm also on the other social media sites, just not as active. YouTube is going to be the main place.
All right, Joseph, this was a great insight and info. And please allow us to have the opportunity to do this again sometime.
Yeah, well, thank you for having me. It was a good time.
That was Joseph Brown from Heresy Financial, sharing his views on the economy and gold. To follow Joseph, please visit his YouTube channel at Heresy Financial and also follow him on Twitter at Heresy Financial. If you like this video, please consider subscribing to our YouTube channel, giving us a thumbs up, and sharing it with family and friends. Audio-only versions of this interview can be found on iTunes and Spotify.